All right, today we are diving deep. We're going to pull back the curtain on the A-plus strategy from one of the world's absolute top proprietary traders. We're here to deconstruct the exact model that's behind some truly mind-blowing results. And when I say mind-blowing, I really mean it. Just look at this number. This is the record-breaking payout that trader Kane has achieved using the exact principles we're about to unpack. You know, a number like that isn't just theory. It is stone-cold proof of a battle-tested, ruthlessly effective way to trade the markets. But here's the crazy part. Behind that massive, multi-million-dollar figure is this surprisingly simple, incredibly disciplined idea. It's not about hitting home runs. It's not about swinging for the fences. It's about consistently getting that base hit. And that contrast right there, that's the key to understanding everything else.
So let's get right into that core philosophy, because this isn't just some abstract rule. It is the entire engine that powers that incredible result we just saw.
Okay, now the simplicity here is really deceptive. Kane's big picture idea isn't about trying to predict some massive, unpredictable market move. Nope. Instead, he focuses on something much, much more probable. Price just pulling back to the halfway point, the 50% mark of a recent range. He's just playing for that predictable rebalancing act that happens over and over again.
So, the big question is, how does he know when that rebalancing is most likely to happen? Well, that brings us to the actual mechanics behind the whole philosophy. It's a market maker theory known as the power of three, or simply AMD.
The power of three, or PO3, is basically a lens that lets you see the market in a whole new way. Instead of chaos, it organizes price movement into a clear three-act story. There's a buildup, then a fake-out, and then the real move. Let's break down each one of those phases right now.
So, it all starts with accumulation. This is that phase where the market just seems boring. It's going nowhere, right? It's coiling up, trading sideways inside a really well-defined high and a low. To a normal trader, this looks like a whole lot of nothing. But underneath the surface, this is where orders are being built up on both sides of the market.
Next up, and this is probably the most important phase, is manipulation. This is the big fake-out. Price will suddenly just rip out of that quiet accumulation range. And what does that do? It triggers all the stops from breakout traders, and it traps them on the completely wrong side of the market. It's a move literally designed to fool the crowd.
And finally, after that trap has been perfectly set, we get the distribution. This is the real move we've been waiting for. Price just sharply reverses and starts heading back in the exact opposite direction of that false breakout. This is the profitable part of the move that this entire strategy is built to capture.
Now, understanding that three-step pattern is one thing. But here's where the real magic happens, where the power is unlocked. You have to realize it doesn't just happen on one chart. You have to start thinking in fractals.
So what do I mean by fractal? It just means that the same pattern, accumulation, manipulation, distribution, is happening on multiple time frames at the same time. They're nested inside each other, kind of like Russian dolls. The real secret here is learning to see how the daily, the 4-hour, and the 1-hour patterns all line up.
So how does this actually work in practice? Well, you always start from the top down. Big picture first. We're looking at the daily chart. The wick of a daily candle often represents the entire manipulation for that 24-hour period. This gives you your high-level bias for the day. So, for example, a long wick at the top of a daily candle, that suggests a manipulation high, which hints that price wants to move lower. Okay, once we have that daily bias, we narrow our focus. We zoom in to the 4-hour chart. And within that bigger daily manipulation zone we just found, we're looking for the exact same pattern on the H4 chart. We're hunting for a specific 4-hour candle wick that shows us a smaller, more refined manipulation area. And then, the final layer of precision comes from the 1-hour chart. This is where the model really helps you pinpoint a potential entry. So now you're looking for a 1-hour manipulation wick that is happening inside the 4-hour zone, which is also inside the overall daily manipulation zone. See how it all nests together?
So here's the absolute crucial point. The A-plus setup doesn't exist unless you get this trifecta. The daily power of 3, the 4-hour power of 3, and the 1-hour power of 3, they all have to be pointing to the same area at the same time. It's this alignment, this confluence, that stacks the odds heavily in your favor. All right, with that whole high-level context set, we can finally zoom in to the sharpest point of the entire strategy, the specific, step-by-step model for actually getting into a trade. This is it. This is the question everyone wants to know the answer to, right?
We have the location, we have the timing, but what's that final signal? What's the thing that tells you, okay, it's time to go? And here it is. This is the final checklist. First, you need that fractal alignment we just talked about, non-negotiable. Then it's about timing. You're looking for this setup to happen right around that key reversal window at 10 a.m. Eastern. Next, a critical confirmation. You need to see divergence between related markets. And only then, after all of that is checked off, do you wait for the final price action confirmation, the break of something called an inversion level.
So let's quickly define that divergence. It's called SMT, or Smart Money Technique, and it's basically looking for a crack in the correlation. Think about it. The NASDAQ, NQ, and the S&P 500, ES, they usually move together, right? They're buddies. But if one of them, let's say the ES, pushes up to make a new high, but the NQ fails to, that is a massive red flag. It tells you there's weakness under the surface, and that move up probably isn't going to last.
And the last piece of the puzzle is the inversion. The easiest way to think about this is like a floor becoming a ceiling. Imagine a small price gap that was holding price up. It was acting as a floor or support. When price finally smashes below that level, the model looks for that old floor to invert and become a new ceiling or resistance. The entry is often triggered on a perfect retest of this newly flipped level.
Okay, so we've got the location, we've got the timing, we've got the entry trigger. But honestly, all of that is totally useless if you don't understand the single most important part of this entire strategy, how risk and the trade itself are actually managed.
And look, every strategy has a trade-off. The upside here is enormous. You can literally catch the high or the low of the day, but the downside is real. It's a risky reversal strategy, it takes a ton of patience, and notice that last point. It results in a lot of break-even trades. Now, most people would look at that and see a huge weakness.
And that brings us to this quote that Kane adopted from a legendary pit trader. This is the absolute soul of his risk management philosophy. You either need to be right or right out. There is no middle ground. There's no hoping, no waiting for it to turn around. If the trade doesn't work and work almost immediately, he's out, often for a tiny loss or just break even.
And this really brings us to the final, most important thought. What if that thing we thought was a con, having all those break-even trades, isn't a flaw at all? What if that aggressive move to cut risk, to preserve your capital, to be right out, is the very engine that allows the profitable right trades to compound over time? It completely reframes risk. It's not something you tolerate. It's something you eliminate at the first sign of trouble. It proves that sometimes the best offense is an absolutely relentless defense.